Welcome to our discussion on futures trading, why beginners lose. We'll explore the common and costly mistakes new futures traders make and what distinguishes successful traders from those who don't make it. Over 70% of retail traders consistently lose money in futures markets. Alarmingly, 90% quit within a year due to significant losses. Most end with zero net profit after fees and slippage. These are documented outcomes, not scare tactics. Understanding these realities is crucial to improving your trading success. Leverage in futures trading is a double-edged sword. A single Standard & Poor's 500 futures contract controls over $250,000 with just a $12,000 margin, creating a leverage ratio over 20 to 1. While beginners see this as free amplification, it magnifies losses as much as gains, posing significant risks. Leverage can devastate accounts. A 20 times leveraged position results in a 20% equity loss with just a 1% adverse move. Recovering from a 60% drawdown demands a 150% gain. Beginners often size positions based on excitement, ignoring risk tolerance and account size. Trading without a stop loss is a critical mistake. New traders often hold losing positions, hoping for recovery, risking margin calls and account wipeouts. Always define your maximum loss before entering a trade. Place stops at technically meaningful levels, and never move stops further away to give it room. Catastrophic position sizing is a common beginner mistake. Risking 20 to 50% of an account on one trade can lead to quick losses. Professionals risk only 1 to 2% per trade, ensuring losses are manageable. Even optimal models like the Kelly criterion suggest smaller fractions, emphasizing survival as key to profitability. Futures contracts differ from stocks as they expire, leading to potential pitfalls for beginners. Key concepts include first notice day, when delivery notices start, and last trading day, the final trading opportunity. Rolling forward involves closing an expiring contract and opening the next, crucial to avoid unexpected settlements and illiquid positions. Trading on emotion rather than process is a critical mistake. Fear and greed are the two most costly emotions in futures trading. Beginners often experience both at once, leading to impulsive decisions and potential losses. A disciplined, process-driven approach is essential to mitigate these risks. The emotional trading spiral begins with a win streak that boosts confidence, leading to impulsive, oversized trades. A large loss then triggers panic, prompting revenge trades to recover. This destructive pattern is common among beginners. Recognizing it is crucial, and adopting a rule-based system is essential to break the cycle. A trading edge is a statistically validated reason your strategy wins more than it loses, or wins enough to offset losses. Without an edge, trading is gambling. Beginners often rely on news or gut feelings, which aren't repeatable edges. A true edge involves back-tested systems, defined setup rules, and positive expectancy. Understanding market microstructure is crucial. The bid-ask spread acts as a hidden tax, eroding your edge in illiquid markets. Slippage occurs with market orders during fast moves, leading to worse fills. Additionally, commissions and fees accumulate rapidly, especially for active day traders, significantly impacting profitability. Overtrading is a common pitfall. More trades don't equal more profit. Each trade incurs costs and emotional strain. Prioritize quality over quantity. Set a daily trade limit. Trade only when setups align, and stop after reaching loss limits. Remember, boredom is not a trading signal. Skipping the learning curve in futures trading is costly. Start by learning contract specs and sim trading in the first 3 months. Develop and backtest strategies from months 3 to 6. Trade minimally with real capital in months 6 to 12, focusing on process. Scale only after consistent results over hundreds of trades. Traders often face psychological challenges like confirmation bias, where they seek information supporting their trade thesis while ignoring contradictions. Loss aversion makes losses feel more impactful than gains, leading to poor decisions. Overconfidence from early wins can be misleading, and anchoring on entry prices rather than market conditions results in holding losing positions too long. Profitable traders treat trading as a business, prioritizing risk management over chasing profits. They understand that consistent execution of their process is key, with profits naturally following. The focus is on flawless execution, not immediate gains. Master the mechanics of trading by understanding contract specs, margin requirements, rollover dates, and settlement rules. Build a rule-based system with defined entry, exit, position size, and maximum daily loss. Protect capital by risking 1 to 2% per trade and using hard stops. Track and review every trade to identify patterns and prevent mistakes. Futures trading demands discipline, patience, and intellectual honesty. The market values your process over opinions. Beginners often fail by skipping steps. Define your risk before every trade, follow your system without exception, and journal everything to learn from each trade. Be the exception, not the cautionary tale.